Hi, I'm David Bodamer, Editorial Director with National Real Estate Investor here at the NBA Commercial Real Estate Conference in Atlanta, and I'm here with Tom Fish, Executive Managing Director with Jones Lang LaSalle. How are you doing?
Doing great, doing great.
So what are you seeing at the show this year?
A lot of optimism, a lot of lenders out there who are increasing their expectations for 2012 over 2011. I think I heard somebody say last night that if you add up each individual CMBS lender's goal for 2012, it adds up to somewhere in the $60 billion range.
Really?
Yes.
Okay.
Now that's what their individual goal is.
Right.
But then the prediction for CMBS origination is probably half that.
Right.
So that just kind of tells you everybody's
going
to be fighting over the same pie. It's going to be interesting to see how that plays out.
So we're seeing the CMBS market come back. The hiccup we had at the end of the year, we're kind of moving past that, and now they're back out there again.
They are back out in force. Spreads are tightening dramatically over the last 45 days. The life companies are still very aggressive in trying to get the best product. The CMBS will be there for maybe a tier down product or secondary markets, and or really large transactions. I think there'll be a player for. But we're very optimistic. I think we can't worry about what dislocation might be ahead of us in the marketplace, and I think that would obviously have an impact. But I think one of the lessons learned over this past summer is if there is dislocation in the market, which there will always be from time to time, the CMBS market recovers.
Right.
And that, it might be unreliable in certain pockets, but over the long haul, it is still a reliable source of financing.
And what about the risk profile of what lenders are willing to look at these days? Is that changing at all? Are they willing to move? We've been talking about Class A, we've been talking about primary markets for a couple of years. Are they loosening that up at all?
The life companies, I don't really see their underwriting standards changing very much. I don't see them wanting to really creep up that much higher in the leverage curve, maybe incrementally a little bit, but I certainly think that the marketplace as a whole is disciplined. They're underwriting properly. They're underwriting at what we still think is the bottom of the trough. And so when people talk about lenders doing crazy things, I would disagree with that. I don't think we're anywhere near that crazy level that we might have seen back in 2005 through 2007.
Okay. And if you're a borrower that's had trouble getting financing in the past couple of years, is that going to open up at all? Like if you're,
That depends on the borrower. There are some borrowers that are going to be in the penalty box for quite some time. There are other borrowers that I think if their track record is clean, but they've just been kind of a smaller borrower, I think they'll be able to emerge. But blemish is a blemish, and those probably won't go away anytime soon.
So what are Jones Lang's goals for this year, or your group's goals?
Well, as the real estate investment banking practice, we did about $12 billion in total volume last year, which was split up among debt origination, note sales, advisory, and equity origination. Our goal is to do more than that. I don't know. If we set a goal, I would say if we could do 20 to 30% more, I think that would be at a minimum growing along with the market. We'd like to do more than that. We'd like to increase our market share, but I do think we expect the market to grow between 20 and 30% this year over last year, and we want to maintain that at a minimum.
Has anything changed in terms of the markets you're looking at, or the property types, and like that kind of breakdown?
Well, we're growing our business in a couple different ways. We're doing a lot of acquisition financing.
Okay.
The acquisition volume is picking up over last year. We're doing a lot of refinancing, and we think that'll continue to grow. We're doing a lot of development deals. We're doing placing equity and debt for new development, and that obviously started, especially with multifamily in 2011. We're going to see that continue as a trend in 2012.
Okay.
Yeah.
And I know you said you didn't, want to, or weren't looking too much at potential dislocations, but are there any things that are potentially worrying for 2012 that you're looking at more than anything else?
Well, at dinner last night we got into a big discussion about Iran and what's going on. So, if what's going to happen in Iran? Well, we can't worry about that. But I will tell you that we have seen with these dislocations is a flight to quality. So even though treasuries are very low, if something like that were to happen, we would expect to see spreads gap out, treasuries come in, lenders maybe put their hands in their pockets for a little while until they understand what's going on. But again, the real estate capital markets are traded on a daily basis, whether you're talking about debt, equity, the CMBS paper, whatever. And so the market's going to clear. The market's going to reprice itself on a daily basis, and that to us is the most important thing. Is much less about what the pricing is, but about the clarity of that pricing.
Okay. Great. Well, I want to thank you for spending a few time with us.
All right. My
and
pleasure.
Stay tuned for other videos in our series from the Mortgage Bankers Association show.